Welcome to the deep dive. Today, we're taking a close look at the aviation industry.
That's right. Specifically where it stands in 2025 and, where it might be headed next.
Exactly. And our guide for this is a brand new McKinsey report, The State of Aviation 2025, just out this May.
Yeah, it's a pretty comprehensive piece. It really digs into the financials, the challenges, the opportunities. It uses a lot of solid data.
Right. And for you, the learner, our goal here is to pull up the key insights. We want to understand, the industry's health, how business models are changing, think low cost versus legacy guys, plus how airlines sell to us now, that whole retailing piece, and the need for better planning, and of course this aircraft shortage everyone's talking about.
We'll try to cut through the noise.
Yeah, make it clear, make it engaging, give you that shortcut to understanding. Okay, so first things first, how healthy is the airline industry right now overall?
Well, the report says 2024 was pretty decent, actually. About 41% of airlines created positive economic value, which sounds maybe not amazing, but compare that to 2019, pre-pandemic. The industry lost something like $30 billion collectively then.
Yeah.
So, yeah, big turnaround.
That is a big swing, especially when you think about, the industry's long-term profitability issues.
Exactly, and that's the really interesting part. Historically, since at least 1996, the industry's return on invested capital, the ROIC.
How well they use their money, basically.
Right, it's generally been below what it costs them to get that capital, their WACC. But in 2023 and 2024, that gap between ROIC and WACC was the narrowest it's been.
So closer to actually making a real profit consistently.
Getting closer, yeah. It suggests some underlying improvements.
But I guess that improvement isn't happening everywhere equally.
No, definitely not. The report shows big regional differences. Latin America, the Middle East, and Africa, they seem to be doing quite well.
Yeah.
Asia Pacific, on the other hand, that's where most of the negative results were concentrated. So location matters a lot.
And are there airlines that just seem to get it right year after year? The consistent winners?
Yes, absolutely. McKinsey identified 7 airlines that actually earned their cost of capital every year from 2015 to 2024 if you skip the main pandemic years.
Wow, 7?
And another 12 that did it for all but 2 of those years. So, yeah, some airlines definitely have a formula that works consistently.
We always hear about fuel prices driving everything in aviation. What's the report say about that link? Is it that direct?
It's actually maybe not as direct as people assume. The analysis suggests you can have good performance whether fuel prices are high or low.
Yeah.
I mean, 2023 and 2024, fuel prices are nominally quite high, right?
Yeah.
But the industry still managed decent ROIC overall.
So it's not just fuel. Other things must be driving success more.
Exactly. It seems other factors are really more important for profitability.
So what are those factors then? What do the winners do differently?
McKinsey boils it down to 6 key things. First, balancing capacity and demand really carefully. Don't fly empty planes. Don't leave money on the table.
Makes sense.
Second, getting good at ancillary revenue, bags, seat choices, all that extra stuff.
Right, the add-ons.
Third, building a reputation for being reliable. On-time performance matters.
Hugely important for passengers.
Fourth, offering unique routes, especially origin-destination pairs where they have an edge. Fifth, being really efficient with their assets, their planes, high capital productivity.
Getting the most out of expensive investments.
And sixth, just having a strong, healthy organization. Good culture, clear direction, motivated people.
So the recent improvements we've seen, it's mostly because airlines got better at these 6 things.
That seems to be the main driver, yeah. Better execution on the fundamentals.
Yeah.
But there were also some big constraints on capacity in 2023 and 2024.
Ah, okay. What caused that?
Mainly fewer new planes being delivered. Deliveries were down 24% in 2023 and then 30% in 2024 compared to 2018 levels.
Significant drops.
Plus engine problems grounded a fair number of aircraft too, tightening things up even more.
So airlines had to, just keep their older planes flying longer?
Pretty much. They responded by extending leases, 11% more lease extensions in 2024 than 2018, and holding on to older aircraft. The average fleet age actually went up.
How much?
From 9.7 years in 2018 to 11.3 years in 2024.
Okay, noticeable. But are more planes coming soon? You hear about big orders?
Yes, that's the good news. As of March 2025, the order books are near all-time highs. So that strongly suggests a wave of new aircraft should start arriving easing those capacity pressures.
Okay, so supply might ease up, but what about demand? Are there worries on that side?
There are, yeah. The report points to a few potential headwinds. Lower GDP growth expected in places like Europe,
Right, economy slows, travel might too.
and the push for sustainable aviation fuels, or SAFs. Good for the planet, but could raise ticket prices.
Which might dampen demand a bit.
Possibly.
Yeah.
And then there's just general economic uncertainty, geopolitical stuff that can shake consumer and business confidence, make people pull back on travel spending.
Let's talk about that ancillary revenue point again. It feels like it's become a huge part of the airline business now.
Oh, absolutely massive. It went from maybe 5% of total sector revenue back in 2010 to around 15% in 2024.
Wow, tripled.
Yeah, and airlines are getting much smarter about it. More personalization, better timing on the offers, trying to tailor it to you.
And loyalty programs, still a big deal.
Huge deal, especially the co-branded credit cards, particularly in markets like the U.S. where card usage and interchange fees are high. They really drive value and, keep customers sticky.
Makes sense. You build up miles, you stick with the airline.
Exactly. Even if they aren't always the cheapest or most convenient for a specific trip.
What about reliability, on-time performance, or OTP? How much does that really affect the bottom line?
There's a clear link in the research. Better OTP correlates with better financial results. And passengers care, 34% said reliable operations boost their loyalty. That's the third biggest factor after price and comfort.
Interesting. How is OTP doing lately?
Well, in the U.S., it was 78% in 2024, which is better than, say, the year 2000, but actually down from a peak of 81% back in 2016. So room for improvement there for many.
The report mentioned network privilege. What's that about?
Yeah. That's basically when an airline has a strong advantage on certain routes, certain origin-destination pairs. Maybe they're the only direct flight or by far the most convenient option.
So they can charge a bit more on those routes?
Pretty much. They have more pricing power. And airlines with more of these privileged routes tend to have better ROIC. You'll often see this with hubs serving smaller secondary markets.
And overall, are airlines getting better at using their capital, generating more revenue per dollar invested?
Yes, definitely a positive trend there. In 2024, they generated $1.23 in revenue for every dollar invested capital. Back in 2000, it was only $1.90.
So significantly more efficient over time.
Right. Better asset utilization, better revenue management, all contributing.
Okay, one last factor from that list of 6. Organizational health. That sounds a bit fuzzier. How does that impact performance?
It might sound fuzzy, but the correlation is strong. Airlines with, clear direction, motivated employees, a real focus on the customer, they tend to have better ROIC.
But are airlines generally good at this?
Apparently not so much. The report found that a staggering 67% of the airlines they looked at were in the bottom quartile for organizational health compared to other industries.
Ouch. So huge room for improvement internally for many airlines.
Huge, especially around things like direction, motivation, and really understanding the external market and customer needs.
So looking ahead just for the rest of 2025, what are the main clouds on the horizon?
Key potential headwinds. Continued demand uncertainty, maybe recession risks lingering, and the chance of rising costs could be fuel again, could be labor, tariffs, that sort of thing. So yeah, cautious optimism maybe, but still lots of uncertainty.
Okay, let's shift gears a bit. Let's talk about the low-cost carriers, the LCCs and ULCCs. Historically, they've kind of been the darlings, right? Better returns than the big legacy guys.
Generally, yes. On a global scale, that's been the story. Better returns, faster growth. But things are changing, especially in North America.
Oh, what's happening there?
It's quite a reversal, actually. Recently, North America, legacy carriers have started outperforming the LCCs and ULCCs on ROIC.
Really?
Yeah, and the growth rates for the low-cost guys there are now actually trailing the legacy carriers. It's a pretty big shift from the historical pattern. Latin America is seeing a similar trend emerge, too.
Wow. Okay. So what's driving that change, particularly in North America? Why are legacy carriers suddenly doing better relative to the budget airlines?
The report suggests 3 main things are going on. First, rising labor costs. That hits the low-cost carriers harder, proportionally, because labor is a bigger chunk of their smaller overall cost base.
Ah, okay, makes sense.
Second, spending patterns are diverging. You've got higher-income folks still spending on premium travel, maybe even more so, but lower-income households, who are often the core LCC market, are feeling pinched and might be cutting back on budget travel.
So a squeeze in the middle or lower end?
Kind of. And third, the legacy carriers have gotten pretty good at fighting back. They introduced those basic economy fares to compete on price directly with LCCs.
Right, the no-frills option.
Exactly. But they can still leverage their bigger networks, their frequent flyer programs, their lounges,
Hmm.
things the LCCs typically don't have.
So they're competing on price for some segments, but still offering the broader value proposition for others. They get the best of both worlds, maybe?
In a way, yeah. They've managed to blunt the LCC advantage on pure price while keeping their other strengths. It's put real pressure on the traditional LCC model there.
But this is mainly a North American story, you're saying. It's not necessarily happening everywhere.
That seems right. If you look at aircraft orders, especially for narrow-body planes, which LCCs rely on, the LCCs globally still seem to be growing faster than legacy carriers outside North America.
Okay, so the model isn't broken worldwide, just facing tougher competition in certain places.
Exactly. The LCC boom isn't over globally, but the dynamics are definitely shifting in some key markets.
So what are the big lessons here for airline leaders everywhere watching this unfold?
Well, two things jump out. One, cost control is absolutely critical, always, but especially when costs like labor are rising. Two, it's not just about price anymore, even for LCCs. The value story price and a decent experience matters.
Right, reliability, ease of booking, etc.
Precisely. And three, there isn't just one way to win. Some might stick to a single brand with different fare types. Others might use a group structure with separate low-cost arms. Strategy matters.
It really sounds like the lines are blurring between the different types of airlines.
Yeah, they really are. The report talks about a convergence of business models. It might be a turning point where just being the cheapest isn't enough anymore for the LCCs. They need to think more broadly about the total value they offer.
Okay, fascinating stuff. Let's navigate now into airline retailing, how they sell flights and extras. McKinsey busted 8 myths here. Myth 1. Airlines have totally nailed customer preferences and are getting maximum value.
True. Definitely not, according to the report. Yes, price is important. About a third of people cite it as, number one, it carries weight in their analysis. But other things matter a lot, too. Ease of booking, trusting the brand, both around 20%. And willingness to pay for things varies hugely. Like, Japanese travelers focus more on price than Chinese travelers do.
So airlines are leaving money on the table by not tailoring offers better?
A lot of money, potentially.
Huh.
The report estimates something like a $45 billion opportunity globally if airlines move from just static bundles to really dynamic, personalized offers based on what you actually value. Baggage, seats, flexibility, you name it.
Right. Don't just offer me a bundle I don't want.
Exactly. They're not yet fully capturing what individuals are willing to pay for.
Okay, myth number 2. More personalization is always better for the customer experience. Is it?
Not necessarily. People want personalization that's actually useful, like real-time help if your flight's disrupted. Right. Or customizing your trip before you fly. That's valued more than just, say, generic personalized marketing offers.
Practical help over just stuff.
Yeah. 70% rated real-time assistance as important. It's about convenience and control. Gen AI might even help simplify this down the line.
Myth 3. People prefer booking everything separately. Flight, hotel, car. That feels intuitive.
But maybe not totally accurate. The survey found almost half, 46%, actually feel positive about well-designed bundles flight plus hotel or insurance activities.
Why?
Perceived discounts, mostly, and it just makes planning simpler. Hotels seem to be the most popular thing to bundle with flights.
Interesting. Does it vary by age?
Oh yeah, younger travelers are generally more into bundles, and there are regional differences too.
Myth 4. A basic website and some ads are enough for airline merchandising. That sounds unlikely today.
Yeah, the report strongly refutes that. Modern selling needs way more sophisticated tools, behavioral nudges, immersive content showing destinations, a seamless experience whether you're on the app, website, or talking to someone.
Omnichannel.
Exactly. That could lift revenue by 10–20%. The best airlines invest way more in data and analytics, and they focus on customer lifetime value, not just the single booking. And yeah, omnichannel is key because most people, 77%, check multiple channels anyway.
Okay. Myth 5. Direct channels, airline websites, and apps will totally take over bookings soon, are they?
Well, they've grown a lot in value, hitting nearly half, 49% in 2024, up from about a third in 2016. But in terms of volume, how many people actually book direct? Only about a third right now.
So indirect channels like travel agents, OTAs are still huge.
Still very significant, and it varies by age. Older travelers tend to book direct more. Plus, new platforms like Chase Travel are carving out a share too.
What would make more people book direct?
Better experience, mainly. 57% said they would book direct if the experience was improved.
Myth 6. Booking frustrations are mostly about clunky old technology. Is that the main pain point?
Actually, no. Price-related stuff bugs people more. Difficulty finding the best price, hidden fees popping up late, limited flexibility on tickets. Those ranked higher than tech issues like complex comparisons or slow process.
Huh. So fix the pricing transparency first.
Seems like it. And interestingly, when asked about overall satisfaction, things like flights being on time and comfort on board were the biggest drivers, even more than the booking experience itself.
Reliability and comfort trumping the website issues. Okay. Myth 7. Digital tools mean people decide on travel faster now.
Counterintuitively, maybe not. The report suggests people are actually more deliberate, more research-heavy because of all the digital info available.
They spend more time planning.
Seems so.
Yeah.
77% check multiple channels. They look at an average of 141 pages of content in the 45 days before booking. Over a quarter spend more than 3 hours just researching.
Wow.
They want control, apparently, and many people actually enjoy the planning process.
Okay, last myth, number 8. Social media is the main place people get travel inspiration.
True. Influential, yes, especially for younger folks like 18, 34-year-olds. Almost half get ideas there. But overall, personal recommendations are still powerful.
Word of mouth.
Yep. And traditional digital channels, search engines, OTAs, even airline and hotel websites are cited more often across all age groups. Social media's influence drops off with age, while airline hotel sites resonate more with older travelers.
So airlines need a broader strategy than just Instagram.
Definitely. A multi-channel approach is crucial, not just focusing on social.
Okay, so airline retailing is definitely more complex than it looks. Let's pivot again to something more operational. Modernizing airline planning. This sounds important, but maybe less visible to passengers.
Oh, it has a huge impact on the passenger experience, even if it's behind the scenes. Planning is incredibly complex for airlines. You've got weather, air traffic control, demand swings, so many moving parts. Good planning means anticipating all sorts of scenarios.
And the report suggests current planning methods are maybe struggling.
Yeah, many are. They suffer from really long, inflexible lead times. You've got commercial teams deciding schedules months out, often disconnected from the operational teams who actually have to fly them. Their priorities might not even align. Exactly. And often the tech is old, using narrow metrics that don't get the full picture. And all this gets worse with more airport congestion, more economic uncertainty, rising costs.
It sounds like a system under strain. Is anyone doing it better? Are there positive signs?
There are, thankfully. The report points to things like airlines creating joint planning teams. Southwest is an example. Also, more agile processes popped up during COVID out of necessity. And better tech is emerging for simulation and optimization, like Amadeus's Sky Suite. So, progress is happening.
What's the ideal future state look like? Fully integrated planning?
Yeah, that's the vision. Imagine a single tool that considers all the constraints, commercial and operational. And a shift in focus instead of just, was the flight on time? Looking at the whole customer journey, minimizing total delay minutes, ensuring people actually complete their trips.
More passenger-centric metrics.
Right. And more dynamic planning, too. Adjusting things days out, not just months in advance, based on real-time conditions.
That sounds like a massive change. What needs to happen to get there?
3 big things, according to McKinsey. First, build the tech and data foundation dynamic systems, maybe digital twins, to simulate things. Second, truly integrate the processes end-to-end with shared goals and KPIs. And third, reorganize the teams, make them more agile, cross-functional, break down those silos.
Okay, a major undertaking. Finally, let's tackle this aircraft shortage. It's everywhere in the news. What's the real story?
Well, the report confirms there is a gap. Demand for air travel bounced back strong, grew over 10% from 2023 to 2024, and is expected to keep growing. But new aircraft supply is constrained.
Why?
A whole bunch of reasons. Aerospace supply chain issues are still causing turbulence. The big manufacturers, the OEMs, are facing challenges. Labor shortages, raw material shortages, those engine issues we mentioned. It all adds up.
And geopolitical tensions don't help the supply chain either, I bet.
No, they definitely add risk. So you have strong demand hitting limited supply.
How big is the shortage, though? You hear some huge numbers thrown around.
Right. If you just compare how many planes were delivered from 2019 to 2024 versus what was expected pre-pandemic, it looks like maybe a 5,000 aircraft shortfall.
Okay, that's big.
But the report adds a crucial nuance: delayed retirements. Airlines have been keeping older planes flying much longer than usual because they couldn't get new ones.
Ah, so the net shortage isn't quite that
That's
large.
exactly. When you factor in those delayed retirements, McKinsey estimates the actual global shortage is closer to 2,000 aircraft. Still significant, but less dramatic. And about 75% of that shortage is narrow-body jets, the workhorses for shorter routes.
Okay, 2,000 planes short. How does that impact everyone in the system? Airlines, lessors, passengers?
It hits different players differently. Airlines
Yeah.
obviously face growth limits, maybe higher maintenance costs on older fleets.
Mhm.
But the flip side is they can often charge more because capacity is tight, higher load factors, higher yield.
Right. Good for their bottom line, maybe not for passenger wallets.
Potentially. Leasing companies, they're doing well. Lease rates for popular planes like the 737 MX have shot up.
MRO's the maintenance guys.
Thriving. Lots of work keeping those older planes airworthy. Engine suppliers also benefit from new engine demand and all the aftermarket service needed.
Who's not benefiting?
Well, the aircraft manufacturers themselves and their suppliers can struggle if they can't ramp up production rates as much as they'd like. Lower production can hurt their financials.
Is there a risk this flips? Could we go from shortage to surplus if production ramps up just as demand cools off?
That's definitely a possibility the report considers. They paint two scenarios. One is a soft landing supply gradually increases to meet steady demand growth. The other is a reversal to oversupply. Demand weakens just as a flood of new planes hits the market.
That wouldn't be good. How can the industry try to avoid that boom and bust cycle?
The report suggests better coordination, aligning stakeholders on a more controlled production ramp-up, building more flexibility into delivery contracts so airlines aren't forced to take planes they don't need if demand drops, and just being really thoughtful, using good scenario planning before making huge capital expansion decisions.
Trying to manage the cycle better. Well, this has been incredibly insightful. A real deep dive into McKinsey's take on aviation in 2025.
It covers a lot of ground.
It really does. You see an industry recovering financially, but still wrestling with some big challenges. Balancing supply and demand, adapting to how we want to buy travel now, getting their planning systems up to speed.
And that whole dynamic between low-cost and legacy carriers, especially in North America, is fascinating. Plus, the retailing myths show how much is still changing in how airlines interact with customers.
Absolutely. And understanding the nuances of that aircraft shortage beyond the headlines is clearly vital. So a complex picture, but a clearer one, I think.
Hopefully, yes. The report provides a solid framework for thinking about it all.
So for you, the learner, wrapping this up, thinking about everything we've discussed, the economics, the tech, how passenger behavior is shifting, what do you think will be the single biggest disruptor for aviation over the next, say, 10 years? And maybe more importantly, how should the different players, airlines, airports, manufacturers prepare for whatever that might be? Definitely something to chew on. Thanks for joining us for this exploration.